Hello and welcome to this very special interview. Another interesting fintech joins me today, and this gentleman looks very young, but don't be fooled by that. He comes with more than 20 years of experience and is building something, or has actually already built something very fascinating. Bhavik Vasa is joining me today. He's the founder and CEO at GetVantage. As you can see, the name itself sounds extremely interesting. Thanks, Bhavik. Wonderful talking to you. You've done so many things in your life, and this seems to be a problem that you are seeking to solve. And just before we got into this interview, you were telling me that you've been with fintech for more than 15 years, perhaps when the word fintech didn't even exist. So my first question, as I said in my intro, that you're not starting out. You've already started out. You've already tried to solve a certain problem, which is of creating a platform of alternative investment solutions, something that has become very, very significant today. We're looking at multiple asset classes. Asset allocation is a very, very important part of investing. So would love to first hear, how's your journey been? Your starting point was to solve a problem. Where have you reached there?
Super. Vivek, thank you. So wonderful to join you and talk about a little bit about how we see the space around us evolve. And I think the word fintech, as you rightly said, right, in my own journey over the last decade plus now in fintech across the US and in India, I think it's simply how technology is democratizing financial services through and through. And I think all amongst that, a very simple thesis that we have at GetVantage, and something that we are trying to say we want to solve for. And you're absolutely right. We are actually just beginning our journey. I still tell ourselves we are in day zero. A very simple thing we are trying to do. We don't want to disrupt anything. I'm sure you speak to so many founders trying to tell you we want to disrupt this or that. I simply say that at GetVantage, we want to try and simplify venture finance. I think it's time in a country like India, where we're seeing this massive amount of growth right in front of us. The opportunity is there, right? We've come to being a 3 trillion economy, number 5 in the world. Can we go to 5 trillion? And to be able to do that, the only thing we need to be able to make sure we solve for along the way is democratize access to capital. We've always been a country of small businesses. And if we can make sure that we get all the credit and capital that these small businesses need to quickly grow and capitalize on this opportunity and this consumption story we have ahead of us. So democratizing access to capital is really what we try and solve for.
And how do you do that? In the sense, when you said venture financing, the way the common person in this country understands it is, thanks to all the media coverage every fundraise gets. You tend to think that it's about equity raising, building valuations, exiting. These are the kind of stories one reads. Is that what venture financing as you see it is, or how have you defined it?
So let's demystify the first thing today in this chat. And I say this with just so many years of experience, having worked in the Silicon Valley, which is considered the mecca of startup and venture capital, as you would rightly talk about it. I want you and all the viewers listening in today to simply go in and do a quick Google search. We don't need to be experts, but even if you just Google search, we'll realize that funding and financing has always actually been of two types. Just over the years, we've just made it glorified that equity funding or venture capital is the only form of fundraising. And then we associate all these different cycles and funding winter around equity fundraise only. But if we were to Google search types of fundraising, you'll actually see there are always two types of fundraising: equity and quasi-equity. And really what it means is these are all forms of capital that a business can take, whether it's considered as money that you take and you part with some equity, and this is a slightly higher risk but higher return capital. And then there are so many different structured finance products and offerings out there And this could be as simple as starting from a traditional bank loan that I think emerging markets and markets like India have always actually built businesses on top of. The venture capital or the equity phenomena is a very new phenomena in private companies, right? In fact, growing up in a household of family businesses, even today, my father doesn't understand what is it, why do I part with equity in my company so early, unless I'm listing or going public. So Vivek, I think the first thing as an emerging economy, we should appreciate, and I tell all my founders, all small businessmen and entrepreneurs out there, is just quickly be aware and make yourself aware of all the different alternative forms of capital that you can have access to, in which you might not need to go and dilute equity or leave any ownership on the table, right? Yes, gone are the days of just very traditional bank financing where you have to give collaterals, where you have to have 3-4 years of profitability. I think there are more options available which allow businesses to really raise capital on some of their other parameters like revenue, cash flows, what are their supplier terms and credit periods. And so I think there are so many other alternative forms that are evolving, and there's so much innovation happening in just how finance can be structured and priced. And all of this is getting available because now there is slightly a more tech intervention and digital intervention across the spectrum. So really what we're doing is giving businesses this access to all forms of capital based on what you need capital for. You might need capital just for working capital. You might need capital for a season that's coming up in your business to just bulk up on your inventory, or you might want to increase your marketing. And so there are just so many different areas that a business should raise money, and just be aware, what are they raising money for and what are the terms to raise that.
So Bhavik, I would love to understand, the fact that when you say there are multiple needs and there are now multiple solutions that you are providing for raising that capital, just want to dig a little deeper into that too.
Sure.
And I'm sure that, there are some products which, and maybe we should talk more over the months and years and get people more educated about them, because as you rightly said, that typically an entrepreneur thinks debt means going to a bank, or probably some of the new fintechs who lend, or you go the VC route. So when you say that, we give a kind of a hybrid solution, if I may use the word.
Yes.
Can you give me an example of a more simpler, let me put it, product that you have where, say, if an entrepreneur needs, let's say, what you would typically do at a seed round stage, right?
Yes.
Maybe say a crore. How would that work?
Sure. Vivek, to answer that and give specific use cases and product types, let's take a step back to really first understand how is this possible, right? Because so many times I hear, and especially when I interact with veterans like you in the space and ecosystem, you'll say, how is this possible? It's too good to be true, right? So first, let's demystify that it's really not too good to be true. It's a reality because the option is now available, and the option got available because if you just track the last decade plus in India, what has technology really done? Taking all of us back to 2009-10, we saw the first step or wave of commerce going digital, right? We saw train ticket booking, travel booking, we saw Amazon, Flipkart. So commerce started going that much more digital, right? And driving and building its cash, we were at front and center of not only seeing commerce go digital, but to make that happen, we had to take money go digital as well. And so then the next inflection point happened, and we all know 2016, we really saw payments, post demonetization, payments go that much more digital, right? So technology made sure that now commerce has gone digital. Your bloodline for commerce to happen digitally is money and movement of money. And so payments had to go digital. And all of us as consumers over the last few years now have started paying that much more digital. That means all businesses are now getting their revenues in a much more digital fashion. So if commerce has gone digital, payments and money has gone digital, it's time for now finance and financing to go digital as well, right? So these had to be the stepping stones to get us till there. What are some of the other things that have happened? For the first time, we now know that it's not very old. It's only that in 2018-19 that we saw GST getting implemented for all small businesses in India. And now that becoming sacrosanct. Now we have a very large pool of small businesses that file a digital tax return on a monthly basis. So you're able to now have access to some digital data on all of these small businesses. So what I'm trying to set the tone for here is that everything that we've seen happen, Aadhaar and identification going digital, UPI taking payments digital, GST enabling a lot more digital data on small businesses, for the first time over the last 20, 30 years, small businesses, MSMEs have always been priority sector.
Yeah.
And on a government agenda from being saying, can we get more capital into this priority sector of small businesses? But it's only getting much more easier now to evaluate, identify, and understand these businesses because this digital ecosystem has happened. And so when this has gone that much more digital, what this allows, and businesses and fintechs like us as GetVantage are now being able to build the robust platform that I can very quickly plug into any small business who comes in and applies and have an entire digital journey for that small business, right from their application for capital they need, from connecting few data points of that company. And so my ability to evaluate, underwrite, do due diligence on these small businesses improves that much. Because of Aadhaar, digital signatures, e-stamp, look at all these small things that have happened around us. It allows me to now make sure that I am able to digitally disburse capital in a much more cost-effective and a digital way, in a paperless manner, to these same small businesses. And last but not the least, of course, there is always risk involved, and probably a lot of different pools of capital didn't reach these small businesses in the past because the ability to make collections was not that digital and possible. We still had to do a lot more physical collections in the past era, in the past decade. But because now these businesses are getting their revenues digitally, we can also very quickly have so many tools of being able to let these businesses either make their repayments in a pull or a push mechanism and are able to collect digitally. Now, when all of this happens, it allows financiers, it allows funds, it allows NBFCs, it allows capital markets and debt capital markets now to be able to come and look at this asset class of small businesses and say, because of this entire digital, paperless, very operational light process and with much more control on collections, we can now offer different forms of financing to them. So here we set the agenda that now finally, because of all of this ecosystem being ready, we are able to come with a lot of pool of capital that can now find its way to this underserved segment of small businesses and SMEs.
So, Bhavik, how does it work out? So, supposing you give a small business, say, a 1 crore loan.
Yes.
And you said that, one of the biggest problems an entrepreneur has is the inability to give a collateral.
Yes.
So, is one of the simpler structured product that, what used to be a pledge mechanism in the older world where the promoter on behalf of the whole company and all shareholders went and pledged the equity and raised, debt from various sources.
Yes.
So is that how this works? That if you say lend, instead of collateral, you take a little certain part of the equity as a pledge, and in the event of a default, you convert it, or how does it?
No. What we've come to the assessment now is that through a much more tech-driven approach, I can very quickly understand the health and performance of a business over the last 12, 18 months. What we are starting to now evangelize is saying that let's truly look at a business's revenues and cash flows as a first grade barometer of their business health, rather than the traditional way where you are basically as a promoter going and pledging a piece of land or your factory or any asset of yours as collateral. Don't need to do that. There is, gone are the days of this perceived value that there is physical collateral, so was secured here, right? I think COVID taught all of us in India and globally that really when you go to liquidate that physical asset, it's really not as valuable, right? So firstly, let's say that, can we move away from the traditional lens of saying physical collaterals are the only way that you can collateralize and secure any form of lending? And how do you do another way to have security? Is literally the platform and the tech we've built is a business comes in, and let me give you a very quick live example. A small business comes in, and this small business could be anything. It might be a traditional small business now starting to sell some of its products online as an online seller on marketplaces or directly to customers. It could be a services business, a SaaS business. It could be in any shape and form of business. But when they can come and now have a complete digital onboarding and journey, come and quickly do an online application, what we're simply saying is, look, through a PAN number and through sharing your and connecting your GST, I'm able to look at your last 12 months revenue trends and what you're filing as GST as a business. Come and connect some of your marketplace or any of the areas that you are doing digital sales. And every business who sells online has a payment gateway, is collecting revenues through credit, debit cards, right? So you have that much more channel of having a direct view, a plugin. It's like when we go and connect in a hospital to an ECG machine, the doctor knows your heartbeats in real. And so through these 3-4 simple connectors that we've already built in, a business can come in and connect and apply. And so gone are the days where a business just shares documents, PDFs, and is submitting their data. We are quickly saying, come connect, and we are validating a data of a business directly from source, right? So you get away from any sort of misrepresentation that would be happening, right? Now, when you've been able to quickly connect to a business's last 12, 18 months of track record, how their revenue is happening, what is their last 12 months monthly revenues, average of their monthly revenues, right? You start understanding from their bank accounts, how is the cash flows of that business coming in, right? What is the revenue, but what is the actual credits coming into their bank account, right? And so you understand cash flow on that business. And so very simply, can you take the last 12 months, average out their monthly revenue run rate, MRR, the average MRR of that business. And what we are quickly able to do is assess and be able to give a business anywhere from 1x to 3x of their monthly average MRR. So exactly what you said, if a business is doing a revenue of, say, like you said, 50 lakhs to 1 crore on an average, right? Can I quickly assess that and give them that 1x, or 50 lakhs or 1 crore that they need for a quick working capital line? Disburse that digitally now. And most importantly, make sure that my security, or the new collateral we say that we take from these businesses, is we connect into any of their digital revenue streams, either payment gateways or marketplaces, and be able to say, hey, as your repayment, instead of that traditional once a month EMI or end of the month, end of a quarter sharing data, can I quickly take a small percentage of your revenues, a small 2%, 5%, 6% of your revenues. So as your cash flow comes in, you are in a very small fashion repaying this 50 lakhs or 1 crore that you've taken. And that's it. The moment you repay that principal and whatever is that additional fee or interest rate, that's it. Your repayment is done. And third, but most important, is not only those same parameters that we did at evaluation and diligence of that business, the revenue, through the tenure of repayment. This could be 6 months, 10 months, 12 months, 18 months, right? Through the tenure of the repayment, those same APIs or same connectors continue to show us the health and the real-time monitor of that business's revenues. So you are not waiting as a traditional lender or a traditional bank. You're not waiting for once a quarter or once a year when you get data on the business and something is blown up and now you're slow to act, right? Your ability to do this live monitoring is what we call this live data, and live monitoring is the new collateral of these businesses. So in summary, what we've really evangelized and brought is new forms of no equity, no collateral, very frictionless cash flow based funding or revenue based funding and financing for these businesses. And we say that the new asset for all these businesses is their data, and the live monitoring and live collections of this is the new collateral. And so all businesses should be able to get qualified based purely on their performance, Vivek. आपके last 12-15 महीने के revenue track record पे you get at least that quick booster capital, growth capital, or inventory capital that you need to get your revenues from X to 2X or whatever be your milestone.
So how does it work on the cost side, Bhavik? Because while it's really fascinating what you're trying to do, but eventually, as you would know better than me, people will say, "Kitna interest
Of course,
dena hai versus if I went to a bank."
it's
So can you tell us a little about that?
absolutely. You know, it's like in India we have that old car commercial, right? सब अच्छा है लेकिन देती कितना है, right? And let me give a perspective to everyone. I think every business, every founder, entrepreneur in its journey should have access to and be smart enough to take all forms of capital. When you're starting off a business, yes, you might need to take some very high experimental capital. You're developing something new, and so you might need to dilute equity and take that first, check of equity or risk-based capital extensively, right? And then you get into some revenues. You might need to take some short-term capital, working capital to keep growing. At a scale, you might need to take some larger debt, longer tenure debt to be able to, and you might have some collaterals by then if you're a production company, etc. And so you might take some sort of a collateralized debt. All this comes at a different cost based on the risk and reward. But Vivek, let me answer this and give everybody a perspective. What GetVantage is being able to evangelize is that irrespective whether you take equity, you take longer tenure venture debt, long-term bank debt, which is collateralized or not, you all need this constant form of working capital and short-term capital. And giving everybody a perspective, and you said, Deti kitna hai? The perspective comes in is that our form of capital, which is no equity, no dilution for a business, is still 30x cheaper than equity capital that a business takes. We very quickly forget, and sometimes it's very glorified and fashionable, like you rightly said early on, that founders or entrepreneurs today want to raise only equity money, talk about valuation, but we all know what the cost of that equity is. In fact, you end up returning 100, 300x because it is risk reward, right? So this form of non-dilutive capital is surely 30x in whichever shape and form cheaper than equity dilution. And on the other side, very traditional venture debt models that are also available, which give you interest rate and take some warrants or some equity and some converts. This is still cheaper than 3x of that. Now, on the other end of the spectrum, if you give your house or your factory as collateral, of course, a bank would only give you debt then. And that would come at about 10, 12%. But take all of this apart, and ultimately, even if you have access to a traditional lender, a bank giving you an unsecured business line of credit, that would come at anywhere between an annual rate of 16, 17%. That is what our cost of capital also is for the borrower. We're not more expensive than any other traditional form of unsecured business line or working capital line. However, what we tell founders is we've innovated on two models. We also say that, look, businesses should not take long-term debt because I'll tell you the unfortunate aspect associated with debt is we always start thinking, "Arey, debt lenge to, we'll get into a debt cycle." The word debt has gotten a little bit badgered. It's actually long-term debt. When you take money for 3 years, 5 years, and you have to pay one shot is when it becomes pressure for a business. What we tell businesses, and you can be as young and small or as mature a business, but it's the discipline of how you can repay your working capital. And tech allows you now to not do a once a month EMI or do once a year repayment. That's when even good borrowers become bad because they didn't pay back in disciplined fashion. So Vivek, we've been able to invent and innovate on that front as well, where you as a business need money for only 6 months, 10 months. We charge you no interest rate. We'll charge you one flat fee, 1% a month. So it could be anywhere between a 6 to 8% that you pay as a flat fee for a short tenure loan, because you as a borrower, you as a business should see what is your cost of capital to the business. Sometimes we feel banks' interest rates are cheaper, but a bank will only give you a 3-year tenure loan or a longer tenure loan, right? So your absolute cost to the business is much higher in that perspective, right? Or like I mentioned to you, the beauty is in the tech perspective, and this is founders and entrepreneurs telling us now, Vivek, that because they are able to pay as a small sliver from their cash flows as it comes in, it's far more easier, and they end up repaying it in a disciplined fashion without them getting to know. Because problem kab hota hai for a small business? When once a month on that same date, I have to pay salaries and payroll, I have to pay my rent, I have to pay electricity bills, and on that same day, there's a big EMI. That's what traditional debt has not personalized. It's your business is different from the guy next door, but a bank will give you the same product. Can we personalize the product towards your cash flows? And tech allows us to do that today. Take all of these aspects and then understand that this is still far more the cheapest cost of capital than traditional venture capital, venture debt, or even a bank loan.
One final question, Bhavik. What are the kind of ticket sizes that you entertain on your platform?
So we love to say that we are here for every small business that is on a growth journey. And hence, a business can come in and take in as little as 10 lakhs to 10 crores from us. That's the sweet spot and range we are able to support a business. And that's where we call ourselves an on-tap capital partner. Don't come and take debt once and sit with it. Our ability to be able to give as little as 10 lakhs to a business, 50 lakhs, 1 crore, or 3 crores in a matter of 48 to 72 hours to a business is where come take when you need money immediately. So every business that is connected with us, Vivek, now, and this is the last advantage of tech that allows us is I don't need to do so much paperwork and put physical man hours. Once a business is connected, taken one round. And what we started seeing founders being smarter is even though their business can take a crore, they come and quickly take 50 lakhs once. And they know that 6-8 months later at season time, they need another quick tranche of 50 lakhs. And they have access to that literally in 48 hours. And so take as much capital when you need it. And that's the power and advantage of technology, the power of personalized or customized financing products we want to give businesses. And hence the name, Vivek, GetVantage. The unfair advantage for every small businessman and entrepreneur and founder out there that wants to grow a business and build for scale.
It's been absolutely wonderful talking to you, Bhavik. I look forward to many more such conversations. I think you're trying to solve a very important problem, especially, for young business women, businessmen from small towns and cities who probably don't even have more than a branch or two to go to, but are digital savvy today. And
Yes.
I think it's phenomenal what you're trying to do. I look forward to many more conversations with you, and I wish you all the very best in your journey.
Thank you, Vivek. It was an absolute pleasure. Thank you so much.